So you're in your 30s, maybe your late 20s, and things are stable now. You have an income, you have enough for some savings, and now you're really starting to think about your future. How do you go from where you are to where you want to be? In this video, that's exactly what we're going to talk about. I'm Mitchel, your heels on the ground in the Miami, Fort Lauderdale area. And on this channel, we talk about everything: probate, guardianship, real estate, out-of-state sellers, and more. So let's get into it. In this video, I want to talk about creating wealth and a wealth mindset. And this is the advice that I give to my own children, children of my friends, or anyone that asks, how do you create wealth? How do you build it for the long term? And when I was younger, I remember having some money saved, and a lot of my friends started taking great trips. Hawaii, getting a boat, getting a fancy car, and all of these exciting things. And I had my mentor really encouraged me to buy income property, and that's what I would suggest you do too. So buying income property, usually that requires a 20% down payment. So if you think about it, if a property is $400,000, 20% would be $80,000. That's a lot of money to come up with, plus closing costs. But did you know that FHA has a program that you can purchase a multifamily property with up to 4 units? So that's like a duplex, a triplex, or a quadplex. As long as you're going to live in one of the 4 units, you can purchase that property for just 3.5% down payment, which is incredible. You'll never get into an income property with 3.5% again. So the trick is you have to live in one of the units, and that's it. It doesn't have to be your first home. It could be your second home, but you do need to reside there. And then you would live there for a period of time, at least plan a year or two. And perhaps then you will have saved up again and you want to purchase another property. You can still keep that property. You have to have lived in it for a period of time, but you don't need to continue to live in it for the life of the loan. And then you could rent that 4th unit, the one that you had been living in. It's a really great way to get in and to start creating wealth. But with that being said, real estate is illiquid. What do I mean? I mean, you have this quadplex, it's going up in value. Maybe it's gone up in value by $50,000, but you can't go to the bank and take that $50,000 out. So you do want to make sure that you're putting away some money every paycheck, every pay period for your future. I would strongly encourage that you diversify your portfolio, that if your employer has a 401k, that you contribute at least enough for the company match. And then there's also a Roth IRA. And the Roth IRA, you put in money after tax, and then that money grows. You can start pulling it out at the age of 59 and a half, tax-free. So there's a lot of different ways to create wealth, but I love starting with real estate because if you think about it, you buy this multifamily property now, and you pay for it every month through the rent that you're receiving from the tenants. Later, you decide to have children. So when that child reaches college age, you'll have a significant amount of equity in that property. If you've been making extra mortgage payments or taken out a 15-year loan, you may even have that property paid off. And what does that give you? It gives you options. So your child's ready to go to college. You could take a home equity line of credit out of the property to pay for it. You could use the income every month from the property to pay the expenses of college. You could sell the property and use that money to pay for college. So it's like you're building this savings plan slowly over time. And my mentor always told me he could show me how to get rich slow, but he could not show me how to get rich quick. And I think that's a really important thing to mention as well. Anyone that tells you it's a flash in the pan, it's one thing, it's going to happen overnight, I would be very suspicious of. I think it's like the tortoise and the hare. With the tortoise, slowly over time creating wealth, and the hair starting off very strong, but then kind of burning out. Another thing that is so important is not to take on any debt with the exception of a mortgage, and if you have to, a car. Credit card debt is just a killer. Right now, we're in a society where people think they want things now, now, now. It's important to get a credit card because you want to build your credit. You need credit in order to finance things like a home. But in getting a credit card, you can pay it off every month. So I would recommend not buying anything that you couldn't pay off in that credit card statement. That way you're building your credit, but you're not creating debt for yourself. I have so many clients who have the dream of home ownership, and when I send them to the mortgage broker, they pull their credit, and even if their credit is good, they look at the income and expenses. And so if their income is substantial, but their expenses are substantial, they may not be able to qualify for a loan. So that income to expense ratio is very important. If you can purchase a vehicle for cash, that is the ultimate. So let's say you have a car that you've paid off. Instead of going ahead and selling that car or turning it in, take the amount that you were paying as your monthly payment and put that into savings every month. So maybe your car payment was $500 a month. After a year, you've got $6,000 in savings. After 2 years, you have $12,000 in savings. After 3 years, you have $18,000 in savings. And then perhaps that's not enough to buy you the car that you want, but it's a significant amount down and you can finance the rest. In financing vehicles also, sometimes the dealerships have great deals on financing, but you can also look at credit unions. They often have really good interest rates, and you can become a member of the credit union to be able to take advantage of their auto loans. I've done that myself in the past. So what are the key takeaways? Don't pay your landlord's rent, pay yourself. Don't take on any debt with the exception of a mortgage and perhaps a car payment. Don't spend more than you earn. And there's an expression called big hat, no cattle. If you haven't heard it, what it means is if you picture a cowboy who has this big hat and you would think that he had tons of cattle, which is his wealth out there, but he doesn't. He just has this big hat and no cattle. Well, that's the same concept of having a really, really expensive car, but you're renting your apartment. Better to put that money into a mortgage and be saving for your future than saving for your landlord's future. If you have any questions, please put them in the comments below. I read all the comments and I'm always looking for questions, other ideas, and any input that you have.